are you? I'm Sherman, the committee clerk.
Nice to meet you.
So glad you could make the time for us today.
I'm gonna correct, I talk.
Yep.
The Subcommittee on Capital Markets will come to order. Without objection, the Chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of the SEC's Division of Corporation Finance. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the Chair for inclusion for the record. I now recognize myself for 5 minutes to give an opening statement. Thank you for joining us today. This hearing will examine the actions taken by the SEC's Division of Corporation Finance under your leadership, Director Eric Girding. These actions have far-reaching implications for millions of retail investors and the overall health of public markets. Director Girding's controversial rulemakings and decisions, I think, threaten to undermine the attractiveness of public markets and stall economic growth at a time when global competition is on the rise. The SEC's primary role is to maintain fair, orderly, and efficient markets while facilitating capital formation and protecting investors. However, the recent actions of the Division of Corporation Finance have deviated from this core mission, pushing an unconventional and partisan agenda that hampers the free market system. The burden of excessive regulations and politically motivated disclosure requirements falls heavily on small and medium-sized companies, impeding their growth. It is crucial that the SEC changes its course and fosters a market system that is competitive and dynamic. One specific area of concern is the rollback of the July 2020 proxy advisor rule, which was intended to ensure transparency in proxy voting decisions. This rollback undermines necessary reforms to the proxy advisor's duopoly and fails to protect the interests of retail investors seeking to maximize the return on their investment. Moreover, costly disclosure regulations on environmental and social policies will harm companies by obstructing their business expansion and hindering them from hiring additional employees. For example, in 2022, investors backed by shareholder activist group As You Sow filed a proposal that Comcast report on its retirement plan options in relation to climate action goals. This attempt to use retiree funds for fringe political purposes could have resulted in lower returns or higher risk for investors had it been successful. Similarly, other proposals, such as emissions targets from Costco, have no material impact on the company's financial performance. By limiting their ability to generate returns, retail investors who rely on these returns for their retirement savings will be directly affected. It is our duty to protect these interests and ensure that their success within our capital markets. To restore the SEC's integrity and realign its actions with its mission of investor protection and capital formation, we must prioritize the interest of retail investors. It is essential that we create an environment that maximizes opportunities for their success. We've heard in previous hearings how important maintaining a variety of attractive pathways for raising capital is for businesses. Excessive regulatory and compliance costs act as barriers to entering the public markets, leading many companies, especially smaller ones, to turn to private markets. Unfortunately, my friends across the other side of the aisle view private market growth as problematic and have pushed for more disclosure requirements and regulatory burdens. For example, it has been suggested that the SEC will require heightened disclosure obligations for large private companies on Form D. Committee Republicans strongly oppose this approach, as it would, in effect, force private companies to go public before they are ready. The recent actions of the SEC's Division of Corporation Finance, along with the proposed cybersecurity disclosure rules, private market regulations, and conflicts of interest in securitizations, pose a threat to our market and free market systems. Our parents and grandparents worked their entire lives to save for retirement. It is the duty of the SEC to ensure American retirement accounts are not used as a tool for partisan, political, social agendas. The SEC needs to follow its congressionally mandated directives to facilitate capital formation and protect investors, and under Director Eric Girding's leadership, this is not happening. I want to thank you, and I eagerly look forward to this morning's discussions on these crucial matters. The chair now recognizes the ranking member of the Subcommittee on Capital Markets, a gentleman from California, Mr. Sherman, for
4 minutes.
4 minutes.
Seeking unanimous consent that the ranking member of the full committee be allowed to present either before or after the witness.
So ordered, for 4 minutes for an opening statement.
This hearing marks the 412th hearing of this committee and subcommittees on the issue of ESG. Shareholders are literally the capitalists. They should be able to decide, and they should be given the information so that they can decide where to invest their money. The Republicans are waging war against the capitalist market that says investors get to decide. They are waging that war on behalf of entrenched managements who don't want the real owners of the company to tell them what to do. We are told that we should have a variety of avenues for raising capital. One important avenue is for climate investors. These are not fringe investors. They're a huge portion of and a growing portion of those who are investing their capital. And this seems like the purpose of these hearings is to tell climate investors to go to hell or to go to Europe, where they can get the information should they choose to invest in European companies. Even investors who do not give a dwit about whether they leave this planet in better shape for their children and grandchildren are going to want some information before they invest in the Maldives Coconut Plantation Corporation, because the Maldives is only about 4 feet high above the water. And maybe that's an investment risk. I've read these documents that go through your division. They list dozens of investment risks. This is clearly one that needs to be examined. I do want to point out that, as the only CPA on our side, that Scope 3 is very difficult to create anything that's anywhere close to reliable. It took the CPA profession 200 years to develop the systems we now use to define and tabulate, audit, and report information. And to try to do Scope 3 is something I haven't heard professors of accounting theory or persons who have headed technical review departments in major CPA firms think that we are quite ready to do. It's not just ESG, we also need W. investors want to know about the workforce. It's the most valuable asset. This 100 years ago, 90% of the value of a company could be seen on the balance sheet listing hard assets. Now, 90% of that value is not in the hard assets. It's in things like the training of and competency of the workforce. And we also need disclosures about China, because it's a risk to many companies that we may see a cutoff or a diminution in our trade relationship with China, and because some investors don't want to see us become dependent upon China. Shifting over to another issue, your division is coming up with conflict of interest rules. As we've heard Republicans say, they're very upset that the SEC is doing so much work so quickly, and I can understand that. We mandated that you draft these regulations only 13 years ago, and in the blink of an eye, here they are. You're moving too fast. 13 years is not long enough. But it is important, much as I've wanted these regulations to move forward, that they be moved forward with care. I'm concerned that ordinary hedging of interest rate risk might be regarded as somehow violative of the conflict of interest rules. And I would hope that interest rate risk and some other things be carved out and not be considered something that could lead to a charge of a conflict of interest. And I yield back.
The chair now recognizes the ranking member of the full committee, Ms. Waters, for 1 minute.
Thank you, Director Girding, for your attendance here today. This is the second week where Republicans are pressuring their culture wars. What's become clear is that Republicans don't like that the SEC wants investors to have information about companies they seek to own or to have the ability to strengthen governance of the companies they own. The Division of Corporation Finance plays a critical role in reviewing the disclosures public companies make about themselves so that investors can understand the financial risk of where they place their hard-earned savings. I commend the division for its good work in protecting investors and improving transparency in our capital markets. You, Director, are strengthening capitalism in America. I yield back.
Today, we welcome the testimony of Eric Girding. Director Girding is the Director of the Division of Corporation Finance at the SEC. We thank you for taking the time to be here, and without objection, your written statement will be made part of the record. Director Girding, you are now recognized for 5 minutes to give your oral remarks.
Chair Wagner, Ranking Member Sherman, members of the subcommittee. Thank you for inviting me to testify today about the activities and responsibilities of the Securities and Exchange Commission's Division of Corporation Finance. It is my honor and pleasure to appear before you today to discuss the division's work. Please note, I am testifying in my official capacity as Director of the Division of Corporation Finance. But my testimony does not necessarily reflect the views of the Commission, the commissioners, or other members of the staff. The mission of the SEC is to protect investors, maintain fair, orderly, and efficient markets, and to facilitate capital formation. In support of this mission, the Division of Corporation Finance seeks to ensure that investors are provided with the material information needed to make informed investment decisions. A large portion of the division's work is done by our disclosure review program, which reviews the disclosures and financial statements of reporting companies to monitor and enhance compliance with disclosure and accounting requirements under the federal securities laws and SEC rules. We concentrate review resources on disclosures that appear to be inconsistent with those laws, rules, or accounting standards, or that appear to be materially deficient or lack clarity. Division staff members conducting filing reviews are assigned to offices that have specialized industry, accounting, and disclosure expertise.
Could you be a little
continue
closer to the
feel-
microphone, please?
Sorry. We continue to feel the impact of the surge in initial public filings from 2021 and 2022. We have seen an approximately 18% increase in the number of active public companies since 2021, and we continue to review thousands of annual reports each year. In addition, the division recommends to the Commission new rules or changes to existing rules as needed to improve investor protection and to facilitate capital formation. These rulemakings benefit from public comments, and we will continue to encourage comments from the public on any new proposals, proposed recommendations that the Commission makes. We also help companies and their advisors to comply with Commission rules by communicating the staff views in a variety of forms, such as staff legal and accounting bulletins, dear issuer letters, staff disclosure guidance topics, updates to the division's financial reporting manual, no action and interpretive letters, and compliance and disclosure interpretations. In addition to providing public guidance, the division serves as a resource for investors, businesses, and their advisors. Our Office of Chief Counsel responds to legal and interpretive questions from the public about the Securities Act, the Exchange Act, and the Trust Indenture Act. Our Office of Small Business Policy provides guidance to small businesses seeking to raise capital or to comply with existing reporting requirements. Each year, this office responds to approximately 1,000 requests for assistance from the small business community. Our Office of Mergers and Acquisitions fields questions regarding business combinations, including domestic and cross-border tender offers, contested change of control transactions, and beneficial ownership reporting. For foreign issuers or domestic issuers undertaking offshore offerings, our Office of International Corporate Finance serves as our subject matter experts regarding specific registration, reporting, deregistration, and exemptive matters. Thank you again for inviting me to discuss the division's activities and responsibilities. I would also like to emphasize that the overview that I have shared with you today does not fully capture the tremendous commitment of the staff of the division to our mission of promoting investor protection, capital formation, and fair and orderly markets. I'm happy to answer your questions.
Thank you, Director Girding. We'll now turn to member questions, and I recognize myself for 5 minutes for questioning. Director Girding, in July 2022, the SEC proposed amendments to rules that would narrow certain grounds under which companies may exclude shareholder proposals from their proxy statements. Specifically, the proposed amendments would make it harder for public companies to exclude shareholder proposals that are duplicative, a resubmission of a proposal that failed previously, or a proposal that a company has already substantially implemented. As you know, these SEC proposed amendments have not been finalized and require Commission approval for them to be adopted, yet SEC staff is already using the proposed approach to decide shareholder proposals, shareholder proposal no action requests. Can you explain, sir, why SEC staff is operating as if these amendments were already finalized?
Thank you, Chair Wagner. As you note, the division did recommend changes to Rule 14A8 in 2022 on resubmission, substantial duplication, and other grounds for exclusion under 14A8. We are carefully considering comments received in response to that proposed rule. But until a rule is finalized by the Commission, we follow existing rules in our informal shareholder proposal process.
Well, as you said, you're still dealing with the comment period. They haven't been finalized, they haven't been adopted, yet you are using the proposed approach. I'll give you an example, just one example of one right here dealing with Altria Group. So I take high exception to this, as do, I believe, the companies and this committee. So I submit this to the record, and I will also make sure you get a copy of it, sir. Yeah. Director Girding, what do you think the weather will be next week?
I'm sorry, Chair Wagner?
What do you think the weather is going to be next week?
I don't know. I would have to look.
Interesting. Next week, I think it's going to be cold and rainy. Director, what will be the effect of artificial intelligence on oil refinery production in 2034?
Commissioner, I would, sorry, Chair Wagner, I would leave that to companies to disclose.
Interesting. I thought it would cost oil companies $13 trillion annually. Director Girding, while these questions may seem strange, that is exactly what you are asking public companies to do under the climate change proposals put forth by the Commission. And given the companies are being forced to guess about the state of the weather or technological innovations decades in the future, how can they possibly provide, in the words of Chair Gensler, comparability and standardized disclosures the rules purport to require?
Chair Wagner, the climate risk disclosure proposal that the Commission voted on last year is about disclosing risk to investors. And risk is about future losses that companies may face. This is the kind of disclosure, the kind of things that investors need to make investment and voting decisions.
Future risk. They're guessing. They're guessing. Director Girding, the SEC reversed Chairman Clayton's 2020 reforms that would have effectively held proxy advisory firms accountable for omitting or misstating material information regarding proxy voting advice or conflicts of interest. Sir, do you agree with Chairman Gensler that proxy advisory firms should be able to omit material information or to provide misinformation regarding their voting advice, methodology, sources of information, or conflicts of interest without being held accountable?
Chair Wagner, the 2020 proxy voting advisory business provisions remain in effect with respect to requiring proxy voting advisory businesses to disclose conflicts of interest. They remain in effect with respect to subjecting proxy voting advice to the federal proxy rules, and they remain in effect with respect to ensuring that proxy voting advice is subject to anti-fraud rules, including Rule 14A9.
None of that is at all answering my question, which has to do with the omitting of material and whether this is okay. My time's expired. I will submit a couple of my other questions for the record. The chair now recognizes Ranking Member Sherman for 5 minutes for questions.
It's true no company can accurately predict the future. Our whole reporting system is designed to calculate the past, and then it's up to the investor to determine what's likely to happen in the future. If you buy Apple stock based on their earnings today, what you're really thinking is that those earnings will allow for dividends to be paid whenever Zuckerberg wants to pay dividends, which could be a decade from now. So what you care about is the dividends. All you can get is a report on the past. Likewise, we can't ask companies to tell us what the temperature of the planet's going to be in 2034, but they can tell us how much greenhouse gases they emitted in a prior year. Sir, it's my understanding that under your Scope 1 and Scope 2 proposal, companies would simply be disclosing what their greenhouse gas emissions were last year, and they would include in that under Scope 2 the greenhouse gases of the utilities that they use. Would they be required to predict temperatures next decade?
No, they would not, Ranking Member Sherman.
But they would have to disclose their own company's emissions during the prior fiscal year.
The climate risk disclosure proposal does include certain transition risk metric requirements for certain public companies, including greenhouse gas.
Well, yeah, that's the risk part may have nothing to do. The company may be entirely green. They may generate all their electricity and everything with solar panels. They may get an award from the Sierra Club. But if they're growing coconuts in the Maldives, they may have a substantial climate risk. It's only 4 feet above sea level, and in some places 4 inches above sea level. I want to shift to the conflict of interest rules. I mentioned these in the opening statement. You're required to issue them, and they make sense as to the first and second prong that you have. The issue here is, does the promoter design a security and then bet that that security will tank? If I was going to buy a car from a company that had bet that that car would blow up, I'd say that's very bad. If, however, General Motors has bets that interest rates will go down or that gas prices will go up or that the Detroit will be in the World Series, I don't care. They're not betting that my car will blow up, nor are they betting on something about something that they control or that they designed. So it makes sense to have your first two prongs, that they can't sell short or have a derivative that in effect sells short the very security that they design. Do we need to make clear, and do you think you do make clear in your proposed regulations, that the promoter of an asset-based security could hedge their interest rate risk or otherwise bet on the interest rate markets?
Yes, Ranking Member Sherman, the proposed rule that you're referring to implements Section 621 of the Dodd-Frank Act. And consistent with that statute, there are in the proposal exemptions for hedging, bona fide market making, and liquidity commitments.
Well, even if it's not hedging, you hedge an interest rate risk if you bet interest rates are going to go up because you have a big position in debt. You may just want to bet that interest rates go up because you think interest rates are going to go up. It's an overall part of the economy. Do you make it clear that on the one hand, you can sell an asset-based security, and the other hand, you can buy a debenture which will be profitable if interest rates go up?
Yes, Ranking Member Sherman, the proposed rule would address conflicts of interest by certain securitization market participants. And the proposed rule includes a definition of what those conflicts of interest would look like, including betting against the asset-backed securities or synthetic asset-backed securities that are being...
I would hope to work with you further to make sure that if you have a conflict if you are betting against the design that you created, but simply betting that interest rates are going to go up or some other part of the economy that you have little or that you have no control over should not be considered a conflict of interest. And I look forward to working with you on that, and I yield back.
Chair now recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Madam Chair. Mr. Girding, I'd like to focus on the Commission's proposed climate rule, which I believe would have a dramatic effect on public companies. There are estimates that put just the initial compliance cost at more than $100 million for some companies. In your rulemaking process, how have you assessed the effects of these costs? What will the effects of these costs have on public companies, particularly the smaller and more medium-sized companies?
Congressman, the rule proposal that you're referring to contains a rigorous economic analysis that looks at the benefits and costs to public companies and public companies of all sizes. That being said, we, as part of every economic analysis and every rule proposal, we solicit comments on the economic analysis. We gather comments, and we've received a lot of comments on the benefits and costs in the economic analysis, and we are carefully considering those in any recommendation.
So do you factor in, do you ask, do you calculate what the cost potentially would be for a public company? Is that a part of the equation, how many dollars? Because that affects the viability of a company, all costs do.
The economic analysis would factor in all costs of the rule on public company reporting, including compliance costs with the disclosure regime.
Have you worked with any other agencies that undertake climate-related rulemaking, such as the EPA, NOAA, the Department of Energy, the FTC, or for that matter, just any other agencies?
Congressman, we consult and talk to a number of federal agencies in our rulemakings, but all of our rulemaking recommendations are based on our statutory authorities and our notice and comment rulemaking, including the comments that we received in response to the rulemaking.
So in a case like this with climate-related rules, in essence, you go it on your own, okay? The proposed rule would also impact private business that are in the value chain of a public company. Public companies that are required to report emissions data will turn to their downstream suppliers, such as farmers and ranchers, to calculate and report their emission data to those companies. We've seen public companies shift their inputs to larger operations that have the resources to track climate and emissions data. Do you know the number of public companies with Scope 3 targets?
Congressman, I don't have that particular statistic with me now. I will note that we have received a number of comments on the impacts of the climate rule proposal on the suppliers that you mentioned, and are taking those comments very, very seriously.
I'd like to know, if it's possible, the number of companies that your people believe would be impacted. And has there been an analysis conducted on the volume of private businesses that would potentially be forced out of the supply chain as a result of this because their bigger partners simply have to turn to someone else?
Well, I want to note, Congressman, that the climate risk disclosure proposal would apply only to public companies. There are provisions in there that would apply to, would require certain disclosures by public companies that may impact other companies, and we're carefully considering all the comments we've received on those.
And I appreciate that, Mr. Girding, because you're a part of the federal bureaucracy, and you know organizations tend to shift their responsibilities and their costs to someone else. I'm just concerned that in public business, the least able to compete, the folks who are having the greatest challenges being a part of the economy, are the ones who will get shoved out of this. Mr. Girding, if climate-related information is material to a company's public operations, or I should say a public company's operations, is that company already required by the SEC to disclose that information, completely absent of the rule? If something is material, they're supposed to say so already, correct?
This is a common misconception, Congressman. The SEC rules do not require public companies to disclose everything material that happens to them.
Has the materiality standard served our capital markets investors well so far?
The materiality standard that we continue to follow is that articulated by the Supreme Court, and we continue to follow the statutory mission that we've always followed, which is providing.
Gentleman, time has expired.
This is fascinating, Madam Chair. Yield back.
Thank you. The gentleman from Georgia, Mr. Scott, is now recognized for 5 minutes.
Director Girding, I want to discuss the SEC's proposed rule. As you know, the SEC's proposed rule requires publicly traded firms to disclose to investors the climate-related risks they face and the greenhouse gas emissions their company is responsible for, including emissions from up and down the company's value chain, which is now known as Scope Scope 3 emissions. And these metrics will be critical in understanding carbon-intensive companies' risk exposure and helping investors allocate capital efficiently and prioritize their engagement. However, I believe that they could have a significantly costly and adverse effect on thousands of small farmers and ranchers. And I understand the rule only applies to publicly traded companies and does not create any disclosure obligation for small private companies. So I'm very concerned about this and the potential of indirect impact that this rule could have on small farmers and ranchers. So my first question to you is, do you see a single scenario where a large publicly traded company that fails or that falls under Scope 3 still chooses to seek data from small agriculture suppliers in order to meet Scope 3 reporting requirements?
Congressman, the proposed climate risk disclosure rule includes a number of provisions that would allow companies that are would be required to disclose Scope 3 emissions to use assumptions, methodologies, and other tools other than getting disclosures from suppliers and customers. That being said, we have received a large number of comments expressing the very concerns that you are expressing today, and we are carefully considering those concerns and those comments as we formulate any recommendation to the Commission.
Let me ask you this. What about large publicly traded banks and other financial institutions who provide loans to small family farmers and ranchers? Could Scope 3 requirements have an unintended consequence on the amount of loans or investment activity being made by these banks?
Congressman, the requirement that you're mentioning in the proposed rule includes a number of provisions, including a materiality qualifier that would potentially limit the number and scope of disclosure requirements that companies would have to make here. We are aware that banks have already developed methodologies for making these kinds of disclosure requirements and assumptions about disclosure requirements.
Well, let me ask you this. This is the pièce de résistance of my opposition. The SEC received a record 15,000 public comments on the rule, 15,000, surpassing the most comments garnered by any single proposal in the history of the Securities and Exchange Commission. Chairman Gensler has recently hinted at potential adjustments to Scope 3. Can you provide some daylight to us as to what these adjustments could be?
Congressman, I can't make any commitment to what a future commission action would look like. I will note, again, that we've received comments expressing a lot of the concerns that you've mentioned today, and we are very carefully considering those comments and taking them very, very seriously.
Thank you very much. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes.
Madam Chair, thank you very much. And Chairwoman, I want to thank you for having this important, what is really a follow-up to the follow-up to the follow-up discussions where we engage the SEC on this outlandish proposal that they put out, Scope 3 requirements. Mr. Girdling, I am very concerned, and I think you'll hear and are hearing from members of this subcommittee that the SEC continues abusing the discretion delegated to it by Congress to undermine the attractiveness of public markets and to hinder economic growth. Your recent focus on non-material environmental, social, and political issues is more than worrisome. 15,000 public comments should have demonstrated that we believe that primarily because your 500-page mandatory climate disclosure rule would be in violation of not just what I think is common sense, but could be considered anti-capitalist and against the ability to grow our economy. I would like to ask you, do you consider inflation to be a primary cause of worrisome that would be to all these public companies where they would want to write about inflation as a material of hindering their growth and their stock price and their ability to hire people and their ability to stay afloat?
Congressman, a number of macroeconomic factors, including inflation, could impact companies and their financial performance.
Well, sir, let me say this, that I think that this administration in particular have downward driven pressure on companies intentionally because of a desire of politics and what I believe is a view of anti-capitalism expressed by this administration and people specifically at Treasury and the SEC. And we think this is a problem. It is diminishing people who would promulgate new business deals. We have engaged the chairman of the committee and told him what we think about how they look at their discretion and the things that it has caused in the marketplace. I want you to know that we believe that this SEC are activists and trying to take a perspective of destroying market gains that might be made, employment by companies, the opportunity to stay afloat and to be competitive with the world. And we think that what is being downward driven by this administration is far more destructive to the growth of companies and their ability to be competitive because of the pressures that have been placed on them. And an example of this is this bill, this 15,000 public comments that have come back to the proposed rule. I think that you should understand that this Congress, by and large, and in particular this committee, we need capitalism. We're in competition with the world. We have pressures that come from other countries, and we would want to be competitive. But because we have an activist government that the President of the United States openly touts as the most liberal, as the most progressive, what we are becoming is one of the boys. And you are arbitrarily harming what has always been in the United States during these last 200 years, an opportunity where freedom and opportunity and individualism, but perhaps more important, entrepreneurship, has been a rule that has guided the United States of America. And it would be my hope that you at the SEC and in particular in the capital markets subdivision would recognize that corporate profits and ability are at risk with the active social agenda that I see. And I hope you listen to us because we're speaking directly to people who make those decisions, and that is what we think. Madam Chairman, I yield back my time.
Gentleman yields back. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch, for 5 minutes.
Thank you, Madam Chair, and thank the ranking member as well. Thank you, Mr. Girding, for your willingness to come before the committee and help us with our work. Director, I just want to go over this a little bit. So this information that you're requesting would aid investors and actually the shareholders, the owners of these corporations to make better decisions with respect to the operation of these companies. Isn't that correct?
Congressman, that's our overall mission and consistent with our statutory authority of investor protection and promoting capital formation. Our rules are about providing investors with information that they need to make investment and voting decisions, including decisions to value the securities that they own or the securities that they may wish to purchase.
So this is, in many ways, this is about managing risk, specifically to the climate change disclosure rule.
That's correct. And Congressman, the disclosures of risk and required disclosures of risk are something that the Commission has required for decades. This is nothing new. Going back decades into the 1960s, the Commission has required disclosures from companies of risks that they face and that could affect the value of the securities that investors own or may wish to purchase.
Exactly. So I come from the construction industry. I was an iron worker for over 20 years before I came to Congress. Also, my degree is in construction management. And I have seen tremendous change in the construction industry. My district includes the South Boston waterfront in my district, and we're building high-rises all along that waterfront. And I've noticed that companies in constructing their high-rise office towers and residential towers are using a whole set of measures and materials that will mitigate the risks that they have from climate change and sea level rise. I have several buildings that have been built in the last 10 years that actually have self-contained water supplies that allow them to release wastewater into the sewage system where they lower their tax rate, their sewer tax rate. I have a company that just built a large residential tower that the first floor, they're right on the water, they're right on the coast. Their first floor has retractable wave barriers. So they have it comes up out of the ground and blocks the ocean from coming in. And if that is not enough, they have designed the entire first floor of their office tower so that they can just drop the water barriers, remove the furniture, and let the water just rush through the building with no damage. And then when the storm is over and the water recedes, they go back into business. So they've done all these measures, and obviously they've got solar energy capacity there. They've done all these measures to induce people to invest in those companies and in those buildings. And doesn't the information that you're requiring help people make those decisions so they can choose companies that are taking a proactive approach to protecting from that level of risk?
Congressman, the proposed climate risk disclosure rule would give investors information about physical and transition risks in order for them to make investment and voting decisions. I would note that many companies, as we note in the release, are already making climate risk disclosures. The key to the proposal, though, is that those disclosures should be consistent, comparable, and decision useful. If companies believe that they are not subject to physical or transition risks, they can disclose that, and investors can make decisions, investment and voting decisions accordingly.
Thank you. It keeps people honest. Madam Chair, I yield back. Thank you for your courtesy.
Gentleman yields back. Chair now recognizes the gentleman from Michigan, Mr. Huizenga. Chairman of the Subcommittee on Oversight and Investigation, for 5 minutes.
Thank you, Madam Chair. Director Girding, in my role as Subcommittee Chair of Oversight, I've requested information relating to the SEC's pending climate rule, and I assume you are aware of this. Over the last month, we've had several of your colleagues before our committee, including the Chief Economist and the General Counsel at the SEC. Frankly, neither of them could, or maybe more accurately would, answer the simple question of why the Chair is stonewalling Congress in our efforts to understand this massive rule. I'm going to get to a couple of questions. I'm going to request that you please don't stall and thank me for my insightful question, which is what they did the entire time. So I assume that your division is in direct contact with the General Counsel's office on this request. So quickly, one, does your division have the responsive material, such as thorough economic analysis, on the climate disclosure rule that you will share with this committee? And I'm not asking for the public documents. Those have been already sent to us. We have those. And two, will you commit to cooperate with us to answer our questions relating to our investigation when they fall within your division?
Congressman, everything that the commission relies on in proposing, voting to propose or adopt a rule is within the proposing and adopting releases. I will note that the Office of General Counsel and other offices are primarily responsible for providing and responding to requests of this committee and other committees.
So you're shoving it off to them. So in other words, basically, we just got to work with them to get the answers that we need. You have nothing to give us.
Congressman, my institutional role is to lead the Division of Corporation Finance, and we do have.
I'm going to move on. Last week, representatives from the two largest proxy advisory firms, Glass Lewis and ISS, appeared before the Oversight and Investigation Subcommittee. ISS testified that they rely on the SEC's legal analysis to determine what shareholder proposals are legally permissible. Mr. Girding, are you aware that proxy firms do not undertake any independent legal analysis of shareholder proposals and instead refer that judgment of your staff as to whether a proposal violates federal rules or federal laws or state laws?
Congressman, my division does not take positions on underlying shareholder proposals.
That's not my question. Are you aware of that the proxy advisors do not do independent analysis and they rely on your analysis, assuming, as they said, that if you, the SEC, allows a proxy or a vote to go forward, a proposal to go forward, then it must meet legal criteria? Are you aware of that?
I'm not familiar with the testimony that you're mentioning. I'd have to read.
We'll print it off. It's public, but we'll print it off and send it to you. So you need to get yourself understanding this. You earlier just told my friend from Massachusetts that you look at material information for investors. So is not knowing whether a proposal would violate state or federal law material to an investor?
Congressman, I think you're referring to our shareholder proposal review process.
No, I'm referring to the analysis, the fact that the SEC does no analysis as to whether a proposal violates state law if it was adopted or violates federal law if it was adopted. Are you aware of that? Yes or no?
Congressman, as we review shareholder proposals, we review...
Okay, how much clearer can I be? Yes or no? You do understand that, or you don't? This is all new information for you.
Congressman, we apply the Rule 14A8 and the grounds for exclusion.
All right.
in shareholder...
Does the SEC analyze whether a proposal would violate state and federal law? Yes or no?
Congressman, I mean, I can refer you to the 14A8 grounds for exclusion as we do our informal...
That is not my question. All right. Since the proxy firms rely so heavily on your analysis, clearly, what other analysis does the SEC conduct with respect to a shareholder proposal? How about that? What do you do? Or do you just assume if the proposal is up, Katie bar the door, it gets on, it needs a vote?
Congressman, part of what the career staff do every year in the shareholder proposal review process is offer informal views on whether any...
What other areas do you analyze? You don't analyze climate, you don't analyze whether it violates state law, you don't analyze whether it violates federal law. What do you analyze that on? My time has expired. Madam Chair, though, I do have a letter that I ask unanimous consent to enter into the record, a letter expressing concerns about the climate disclosure rule written by 2 former SEC chief economists.
So ordered. The chair now recognizes the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair, and I'd like unanimous consent before I start to include this letter into the record from Out Leadership in support of continuation and expansion of ESG reporting and metrics.
So ordered.
Director Girding, I want to start just giving you a chance to respond to some of what's here. I feel like we need to just sort of bring this all down to a really simple reading level because I don't think these issues are that complicated, but I want to make sure everybody in the room understands. Can you remind us of the definition of materiality that guides the commission?
Congressman, the definition of materiality that the commission follows is the one that the Supreme Court has articulated in cases like TSC Industries versus Northway and Basic v. Levinson. So all of our rules are following Supreme Court precedent.
So can I summarize Basic v. Levinson as I think the quote is a substantial likelihood that the fact would be viewed by a reasonable investor as having significantly altered the total mix of information made available. Is that a pithy summary?
That sounds accurate.
Okay, and can you just remind us why the committee believes that the proposed climate risk disclosure rule fits this definition of materiality?
Congressman, the climate risk disclosure proposal is aimed at providing investors with disclosure for them to make investment and voting decisions, including for them to analyze risk in order to value the securities that they hold or may purchase. So the whole focus of the proposed rule is on providing investors with with disclosures that would be relevant for their investment and voting decisions. So that's the overall concept of materiality.
Okay, and this rule has been up for public comment for a long time. Can you estimate roughly what percentage of the comments you've received have been favorable with respect to the rule?
Congressman, I don't have exact statistics on proposals, comments that would be supportive or opposed to the rule in front of me. I would note that we've received a large number of comments that support the proposed rule. We have received comments that have expressed concerns with the rule, and we're taking all of the comments extremely seriously.
Okay, well, we can follow up with you afterwards. We had some analysis I mentioned in the hearing last week that over 90% of investors responding were supportive of the rule, which certainly sounds like a lot of reasonable investors to me. In 2010, the SEC issued interpretive guidance regarding disclosure related to climate change. Have you seen adequate compliance from companies with this guidance? So in other words, are SEC registrants already disclosing sufficiently material climate-related risk in their filings?
Congressman, I think you're referring to the 2010 guidance that the staff put out on climate-related disclosures. We have seen companies make disclosures on those matters, but it's been our observation that those disclosures are not always consistent, comparable, and decision useful. And that is, as we explained in the climate risk proposed rule, part of the reason for the overall rule.
Okay. And I think, relating to that, and I think you said this to Mr. Lynch, but just to clarify, in the absence of this rule, what I think you're saying, I don't want to put words in your mouth, is that the passage of this rule would provide investors with a better understanding of the risks that they face in their portfolio so they can allocate their capital accordingly and risk would be better priced. Is that a pithy enough summary of the SEC's position?
Congressman, that's something that is part of this role and part of what we've done for decades. Again, providing investors with information about the risks of the companies in which they invest in. And part of that is what investors use to make investment decisions and to construct investment portfolios.
So I said at the start that I feel like I need to dumb this down. This is so simple, right? People want information, they're demanding information, we're trying to give them information. And if you give people information, they will allocate their portfolio and better price risk. And my colleagues seem to be bringing a lot of witnesses in here who are saying, well, if we pass this rule, we will see divestments from certain sectors. No, we won't. We will see divestment from lousy managers who are incapable of responding to investor pressure, because if investors move their capital and the price goes up and you don't respond to that, welcome to capitalism. Capitalism is scary. It's frightening if you can't compete. And I hope that someday the Republican Party embraces capitalism and investor rights once again. Thank you. I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you, Madam Chairwoman, very much. Thank you, Director Girding, for being here with us today. So many actions trouble me about the SEC, including is the pace of rulemaking, limited comment periods, aggressive implementation timelines, and the lack of responsiveness to congressional concerns. This breakneck pace is exhausting the SEC staff, as you probably know, and overwhelms the industry, which I know, with broad new rulemaking without enough time to comment. And congressional inquiries are sometimes at painstakingly head-shaking lengths of time. So I want to bring up that the examples of some of these extensive time frames are the climate disclosure rule, as well as the proxy advisory rule, which you allowed 30 days for comment, and that was over Thanksgiving and Christmas. So not really looking for some substantial input. Madam Chair, to demonstrate the breakneck pace of the SEC's rulemaking agenda compared to previous chairs, I ask for unanimous consent to submit this chart entitled Rule Proposals Issued During the First 27 Months of SEC Chairs' Tenures. For the record, this chart shows that after 27 months, Chair Gensler has issued 58 rules compared to the 33 rules issued under Clayton and 30 rules issued under White. So the rules have doubled, and the comment periods have decreased by 20 to 25%, respectfully. But Mr. Girding, let me ask you this. Can you identify which of these 11 rulemakings would actually advance the SEC's mandate to facilitate capital formation?
Congressman, all of the rules that my division recommends proposing or adopting are squarely within our statutory mandate of investor protection, capital formation, and promoting fair and orderly markets.
Yeah, do you think the industry agrees with that? Do you ever ask?
Congressman, we receive a wide range of comments on all of our rulemakings, and we take all of those comments very, very seriously.
All right, so when proposing these very significant rules that impact millions of Americans and have broad implications, stakeholder input and sufficient comment periods, one would very rationally think roundtables, concept releases, and other outreach mechanisms should be an important part of it, because that's the industry that you're trying to help and advance and promote, correct? So why is it then that we have the data that shows a conflict with what you're saying?
Congressman, we take the notice and comment process extremely seriously. I believe that all of the comment periods are not only adequate under the Administrative Procedures Act, but have generated robust comments on our rules. We carefully consider those comments, and again, that's not just our obligation under the Administrative Procedures Act. That makes for better policies and better recommendations from the division.
I don't think your clientele, and maybe you don't look at it that way, but I tend to, would agree with a 216% increase in new rules, but 20% less time to comment on this plethora, this blizzard of new rules. But you think that everything's just going fine and no reason to change course?
Congressman, again, we take the notice and comment rulemaking and our obligations under the Administrative Procedures Act very, very seriously. And the public is my clientele, and we take our statutory authorities, our statutory mandate extremely seriously.
Okay, but you agree that your time frame is about 45 days, where before it was a good 20 to 25% longer in comment period time.
Congressman, again, like I believe all of the comment periods for all of the rule proposals that we have recommended are adequate under the Administrative Procedures Act and have yielded comments which we are carefully considering.
If you did hear, as I do, the timeframes are not sufficient and the number of rules coming across are very difficult to deal with, would you then consider and commit to this committee to review your timeframes and level of rules being issued to better accommodate the American investor and industry?
Congressman, we receive a number of comments on our comment periods, and we carefully
Unfortunately, it
consider
sounds like a
those
no.
as
Madam
well.
Chair, my time has ran out. I yield back.
Chair now recognizes the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Madam Chair, and thank the ranking member for this hearing and the witness. Thank you very much for being here. Madam Chair, before I begin my questions, I'd like to submit into the hearing record a letter signed by Family Farm Defenders, Food and Water Watch, Institute for Agriculture and Trade and Policy, and Union of Concerned Scientists.
So ordered.
Thank you very much. Thank you, Madam Chair. The ESG disclosures are a market-driven initiative to increase investor education and corporate transparency. Information from ESG disclosures will help investors gain greater insight into what companies are doing to reduce carbon footprints and to address important issues like climate change, diversity, and labor rights. Investors understand that ESG issues are material and need to be accounted for when assessing market opportunities. And again, these are the investors. I mean, investors are smart people, and I think that's why, 77% of the large Fortune 500 companies now have ESG disclosures, because investors want to know this information. And I think what you guys are attempting to do here is very appropriate. It's been a long process because there's been a lot of comments, and there should be, to try to figure out, how do you measure this? Is a very complicated issue. There's no doubt about that. But this is very important. But again, it's investors. And why? Investors read the headlines. Do you read the headlines, Mr. Girding?
Yes, I do, Congressman. I read the Wall Street Journal every day.
Yeah. I mean, the headlines recently have been screaming about climate disasters. I just talked to someone from Phoenix who said, it's 118 degrees, but not that it hasn't been that hot before, but it's never been that consistently hot. It's been hot like that now for a long time. I mean, you take a look at what happened up in Vermont. You take a look at what's happening around the world, Europe right now. I mean, these climate disasters cost money. You take a look at what insurance companies are doing in Florida and California, because again, climate change. Investors take a look at this. Investors believe this is material. And of course it's material. It costs billions and billions of dollars. So of course it's material. Do you think it's material?
I'm sorry, Congressman.
Do you think that the issue of climate is material? Do you think investors are correct about that?
Congressman, as part of the proposing the climate risk disclosure proposal, my division, as part of our recommendation to the commission, my division was aware of and cited a large number of investors who expressed a desire for the types of information that are in that climate risk proposal. And that information, as you note, is about helping those investors make choices, not the commission, but those investors make decisions with required disclosure about their investment and voting choices.
Yeah, sometimes when I'm up here listening, it sounds like there's some accusations that you guys are doing this for yourselves, somehow for the commission. No, it's for the investors. Investors want to know, and especially savvy investors, because they do see what's coming up, and unfortunately, the scientists that we read, and certainly I think that most commonly speak about this, say there's going to be more of this. So of course savvy investors want to know this information to make sure that they're not going to invest in a company that's very short-sighted. They want a company that's going to be around for a long time because they manage these risks. They understand the risks of climate change and climate disaster. And again, I think you guys are on the right track. There is the question of, do you take a look at the comments that people make? There's so many of them. I believe you do. Isn't that correct? I mean, you take a look at these comments, and by the way, the number of them are interesting because now digitally, you can do anything. I mean, when they move $42 billion out of a bank in one day, the world has changed. The reality is, because of the digitalization, things move quickly. But do you take a look at these comments, and do you take them seriously?
Absolutely, Congressman. We carefully read each comment. We take the comment process extremely seriously, whether they're comments supporting or opposing or expressing concerns with a particular proposal. And that is part of our duties under the Administrative Procedures Act. It's also what makes for better policy and better rules.
Well, again, I thank you for being here. I thank the chair for holding this hearing and the ranking member, and I yield my time back.
Watch your hand.
Gentleman yields back. The chair now recognizes the gentleman from Wisconsin, Mr. Steil, for 5 minutes.
Thank you very much, Chairman Wagner. I'm really concerned about the direction the Securities and Exchange Commission has taken under Chairman Gensler. And I want to go back to a few things you said here today, in particular as it relates to shareholder proposals that are looking for no action requests. And did you tell us that the Securities and Exchange Commission does not review whether or not the actual shareholder proposal is legal or not legal in order to issue your recommendation?
Congressman, when the staff conducts their informal process under 14A8, we look at all grounds for exclusion under 14A8.
Understood.
And offer informal views on whether any of those grounds for exclusion apply.
Correct. I understand that. Are you willing to say on the record that you do or do not look at whether or not an action is legal federally or in any given of the 50 states?
Again, Congressman, we look at all grounds for exclusion.
Do all grounds include legality?
One of the grounds would require the commission to look at a number of factors, including that one.
Can you say, so yes, you do look at legality?
Again, Congressman, we apply
This is a real, without being difficult here, this should be a really simple question. You either yes, you look at legality, or no, you don't look at legality. Do you look at legality?
We look at all grounds.
I get all grounds. Do all grounds include legality?
Congressman, I'm happy to refer to you to 14A8.
No, don't refer me to anything. Do you look at legality? I got you here in front of me today. Do you look at legality?
Congressman, we don't offer opinions on the legality of individual...
So no, you don't. So here's the problem. If no is your answer, here's the problem. We had in last week ISS and Glass Lewis, the duopoly that dominates proxy advisor advice. And I asked ISS and Glass Lewis, do you look at legality? And they said no. On the record, no. Why? Because they said the SEC does. And now what we're hearing from you is, after trying to delay answering the question, no, you don't look at legality. So here's the problem. We have the SEC coming forward and allowing a whole host of ESG-related reforms. We look at companies like Travelers, who pointed out to the SEC that if they had their shareholder proposal move forward, it would be illegal. Why? Because it would have required Travelers to adjust pricing based on race. They pointed out to you, the SEC, that it would have been illegal for them to do that. You didn't care, not you personally. The SEC didn't care. The SEC allows it to go forward. The proxy advisors rec in favor, and the proxy advisors point to SEC, saying that they don't do the review of whether or not it's legal. That's the job for the SEC. You're now telling us that you don't review whether or not an action is legal. And so what we have is a complete lack of accountability. And then Chairman Gensler goes and guts Chairman Clayton's proxy advisor rules so that the proxy advisors aren't on the hook either. No one is on the hook. And then Americans are wondering why their retirement savings are being weaponized to advance a woke liberal agenda. Well, here it is. Anyone can submit a proposal. That proposal can be illegal. SEC doesn't care. The proxy advisors don't care. And you have instances like the Travelers case, but there's plenty of them out there. But in the Travelers case, 46% of shareholders voted to have Travelers engage in illegal behavior. And then you have boardrooms pulling their hair out, saying we should be focusing on growing our businesses, growing jobs, but instead we can't because the SEC is asleep at the switch. Chairman Gensler gutted the proxy advisor rules, so the proxy advisors aren't on the hook. The proxy advisors are advising in favor of this. People should be darn frustrated with what's going on. And the lack of accountability at the SEC under Chairman Gensler by gutting the Clayton proxy advisor rules should frustrate the American people who are watching their 401ks, who are watching their pension funds that they're relying on for retirement, being weaponized against them to advance a liberal agenda. And you just finally admitted on the record that you don't review whether or not an action's legal. And the proxy advisor said they rely on you to do that part of the job. Well, I think we've identified a massive problem at the SEC. I think we're highlighting what happened when the SEC gutted the Chairman Clayton proxy advisor rule. And I think it's all the more reason that we have to go in and actually put some controls with the proxy advisors. And we're marking up that bill next week, and it's essential that we get that passed on behalf of the American people. Madam Chairwoman, I yield back.
Chair now recognizes the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you so much, Madam Chairwoman. Director Girding, good to see you here. I represent North Carolina's 13th district, which includes Raleigh, the Raleigh suburbs. We don't get out to Durham and Duke, but I get the question a lot, which is Duke, Carolina, Duke, NC State. You get those versions. For me, that's always a trick question. You don't want to answer any of those if you want to get elected in the triangle. But for you, if I say Duke, Carolina, who do you choose?
Congressman, my dad is a Tar Heel, so I'm going to choose not to answer that question.
I saw you went to Duke. My wife is a Tar Heel too, so I also avoid answering that question. But for me, in the 13th district, housing is consistently one of my constituents' biggest concerns. Escalating costs have created significant barriers to entry, making it increasingly difficult for aspiring homeowners to fulfill that American dream of owning a home. And I'm concerned that the SEC's proposed conflicts of interest rule may have negative effects on the housing market by preventing the securitization of assets. I certainly share the Commission's goal of preventing conflicts of interest, but I hope that the final rule isn't overly broad. In 2021, over 65% of mortgages were securitized, which is the key to providing stability in the housing market. How important do you think securitization is to mortgage lending?
Congressman, I think securitization is incredibly important. As we proposed the rule, we carefully considered the statutory mandate from Congress to pass the conflicts of interest rule. We carefully considered our recommendations to the Commission on the scope of the rule and the hedging, market making, and liquidity commitment exemptions. And we've received comments on the scope of the rule, the definition of conflicts of interest, and those 3 exemptions, and are carefully considering those and the economic analysis of those provisions.
So if firms aren't able to participate in securitization because of an overly broad rule, just taking that hypothetical, how would this impact the liquidity and stability of the housing market?
Congressman, the proposed rule contained an extensive economic analysis of the economic benefits and costs of the rules. We've also solicited comments on how the proposed rules, what the economic costs and benefits would be, and are taking those comments very seriously as we formulate any recommendations to the Commission on that.
And so you have conducted a cost-benefit analysis that examines how this proposal would impact affordable housing?
The overall economic analysis, which I refer to you in the proposal, looks at the broader economic potential economic costs of the proposal, including on a number of securitization markets.
I've also heard from industry participants that mortgage insurance-linked notes could be inadvertently captured by this regulation. These are used by private mortgage insurers to manage capital and serve homebuyers across the country who continue to experience affordability barriers. Has the SEC considered tailoring the regulation to ensure that this isn't an issue?
The proposal solicited a number of comments on tailoring the rule, changing the scope of the rule, and changing the scope of the exemptions. We've received a number of comments, including comments expressing the type of concern that you've mentioned, and are going to carefully consider those comments as the division formulates any recommendations to the commission.
Thanks so much. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Madam Chair, and appreciate you having this hearing today. Thank you, Director Girding, for coming. Congress plays an important role in encouraging agencies to achieve regulatory harmonization across federal government in order to ensure that any additional incident reporting requirements do not create duplicative regulations. I'm speaking specifically to cybersecurity. The SEC's proposed cybersecurity disclosures require issuers to publicly disclose a material cybersecurity incident within 4 days using Form 8K. This is, I believe, falls under your department. Additionally, there are rules that introduce new obligations on risk management and governance, including disclosure of policies, procedures, and board members' expertise in cybersecurity. All this comes when the SEC has proposed 5 additional cyber disclosure rules. I've heard from a number of stakeholders that have said about 40% of their cyber staff's time they spend it on compliance matters instead of the day-to-day protective mission. And some experts in the field believe that this could rise to 50% in the near future with all these other regulations coming out. With all this in mind, Mr. Girding, have you, as your department, worked with or received technical assistance from other agencies such as CISA on the implementation of this proposed rule, and how it may interact with existing regulations and laws?
Congressman, we've consulted with a number of federal agencies on the rule proposal. We are also carefully considering the interactions of this particular rule proposal with other federal statutes and other federal regimes. So we've also received a number of comments on the proposal related to the issues that you're mentioning, and are carefully.
Did you speak to CISA about this?
That is one of the federal agencies that we have spoken to about the rule.
So
yes.
they have a 72-hour disclosure rule. Why make yours 4 days? And why make it public? Because CISA's rule isn't public. And when you talk to them, did you get a differing opinion as to why draft this as what you should not do with this rule? Or I mean, what was the discussions? Did you just say, hey, we're doing this?
One clarification, Congressman, the cyber incident security reporting provision that you're talking about is 4 business days after a public reporting company would determine that a cyber incident is material.
Yes.
I will note that we are closely following our statutory authorities, which may differ from those of CISA under other rules.
I understand that, but do you understand that there are businesses out there and who have cyber employees, which a lot of them have shortages. There are 750,000 open jobs. And when their employees have to spend 40% of their time doing compliance matters, wouldn't it be better for the SEC and CISA and other agencies to say, hey, you know what? Maybe 72 hours works for all of us instead of 72 hours for you, 4 days for you, 48 hours for somebody else. That's what I'm saying. We need to get these people back into the job that they're supposed to be doing, protecting the companies. So I think when you have these discussions in the future, it doesn't matter about statutory authority, there's still supposed to be harmonization. And that's what Congress wants to see. So next time these rules come up, I hope the SEC takes that into consideration, especially considering there are 6 rules that the SEC is proposing, and they're not all under your department, but they don't make sense together. So I think that's something over there you all at the SEC have to really focus on. I do want to move over, because I have a little bit of time left, over to the changes to the Bulletin 14L. How do you justify the shift? How does the SEC justify their shift in their position? Did they study how the increased number of ESG proposals would affect shareholder value and the ability of corporations to make efficient and effective business decisions?
I think you're referring to staff legal bulletin 14L. So Congressman, that is informal views of the staff as we conduct our shareholder review process. It's not legally binding. It's not a rule or notice. It's not notice and comment rulemaking.
How much discretion do staff members have when they are determining whether something is exempt?
I think you're asking about the informal shareholder review process that we have. So that is driven by professional career staff. It is something that offers informal views to both management and shareholder proponents as management elect to seek a shareholder, a no action letter from the.
Expired. You could perhaps respond in writing for the rest of your answer. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Madam Chair, and thank you for holding the hearing. Let me just take a few seconds to just associate myself with the comments earlier of my colleague from California who talked about the weather, the impact of weather. The projected temperature today in Phoenix, 115. This will be going into the 12th day above 110, and I'm going to go around the country and frankly around the world to point out how the weather is dramatically and dangerously changing. But let me go on to another issue that I'm very concerned about. My colleague and I, Blaine Luchtenauer, sent a letter to the SEC on May 23rd, and went to Mr. Gensler. And this issue you addressed a bit earlier, but that's the section 27B that one of my colleagues raised a few minutes ago, and we sent a letter in May to raise the concerns that mortgage insurance linked notes could be interpreted, as has been suggested, to be a conflict of interest under this rulemaking. After hearing from a number of housing organizations, mortgage insurance linked notes are used by mortgage insurers, they believe, to disperse concentrated risk and provide protections against elevated losses. And I don't believe that there are the sort of transactions the rule is targeting. But given the fact that the Division of Corporate Finance oversees the Office of Structured Financial Responsibility for the rule, have you had any time or have you spent any time with your staff to work through these concerns raised by Congressman Luchtenauer and myself?
Congressman, thank you for that. I've read your letter and the letter that you co-wrote with Representative Luchtenauer, and we have put it in the comment file for that rule. We have heard we've read a number of comments and heard a number of concerns, including the ones that you have expressed. I will note that I don't want to prejudge the particular facts until I fully understand them, but I'm not sure that the particular financial product that you're mentioning would in fact be covered by the rule. And we will carefully consider your comment and all comments as we address those particular concerns, including on the scope of the rule.
Well, obviously, I have a lot of concern about housing and real estate, the real estate industry as it relates to this rulemaking. But I think I can speak for Mr. Luchtenauer when I say that we would be very much interested in sitting down with you, or even having members of our staff sit down with your staff to do some final discussions before the publication of the final rule. Is that possible that we can have some kind of conversation on that rule?
I would be happy to meet with your staff. I would have to work with our Office of Legislative Affairs, and we may have to put a memo to the file, obviously, like if we're considering facts or data on the rule, but I assume that you and Representative Luchtenauer would be comfortable with that.
I think we would. Spoke with him, but I believe we would. Madam Chair, I yield back. Mr. Chairman, I yield back.
The gentleman yields back. The chair now recognizes the gentleman from New York, Mr. Lawler, for 5 minutes.
Thank you, Mr. Chairman. Staff Legal Bulletin number 14L explains that the SEC has shifted its focus from the materiality of a shareholder proposal to a company to the social policy significance of the issues. This change has made it significantly easier for politically motivated proposals to be included in annual proxy statements. The result is clear, as we have seen a 51% rise in environmental proposals, a 20% increase in social proposals, and a 25% decrease in companies seeking no action relief. By focusing on costly non-material ESG issues at the expense of sound financial regulation, this shift detracts from the primary purpose of public markets to enable companies to raise capital and foster economic growth. Mr. Girding, Staff Legal Bulletin 14L states that certain exclusions under Rule 14A-8 should not apply when a proposal relates to the staff determines to be significant social policy issues, regardless of whether the issue has a nexus to the business. In fact, I'll read, for these reasons, staff will no longer focus on determining the nexus between a policy issue and the company, but will instead focus on the social policy significance of the issue that is subject to the shareholder proposal. In making this determination, the staff will consider whether the proposal raises issues with a broad societal impact such that they transcend the ordinary business of the company. Under this aligned approach, proposals that the staff previously viewed as excludable because they did not appear to raise a policy issue of significance for the company may no longer be viewed as excludable under Rule 14A-8. Now, you say this is informal, not a big deal, but yet this obviously is having a dramatic impact. Can you explain to this committee 2 or 3 criteria that the Division of Corporate Finance uses to determine whether an issue has a broad societal impact?
Congressman, when you refer to Staff Legal Bulletin 14L, that was reverting to a previous position that the staff had taken and that had followed for several decades of not tying that particular inquiry to a particular company. And we believe that is consistent with commission statements on that regard. So we were reverting to earlier views and earlier...
Okay, that's wonderful, but I asked you a different question. I asked you, what criteria do you use to determine whether a particular issue has a broad societal impact? Who elected you to determine a broad societal impact?
Congressman, the overall inquiry there that the staff engages in a non-political way in formulating...
In a non-political way? Are you kidding? Come on. Let's be real here. This has been entirely political. And again, I ask you a question. What criteria do you use to determine a broad societal impact? Stop trying to circumvent the question. Answer it directly.
Congressman,
what criteria?
Congressman, in formulating the career staff's informal views on this particular grounds for exclusion, the staff considers whether a particular matter has become a question of widespread public debate.
Who are you to determine what has become widespread public debate? Did you run for elected office?
I am not an elected official, Congressman. I am here to carefully follow our statutory authorities, including protecting investors and promoting capital
So what
formation.
statutory authority do you have to determine broad societal impact? Like, what criteria are you using to determine that?
Congressman, when the Commission staff, the career staff, are looking at the ordinary management grounds for exclusion, we are carefully considering the Rule 14A8. We are carefully considering
Except
Commission
you're having
statements.
exceptions for it based on some undefined criteria that you still can't answer.
Again, Congressman, the criteria that we are looking for in offering informal views is whether a matter has become a subject of widespread public debate. And the
So give me an example of one.
His time has expired. Chair now recognizes gentleman from Iowa, Mr. Nunn, for 5 minutes.
Thank you very much, Mr. Chairman, for calling today's hearing, and for the groups on both sides of the aisle who have, I think, some legitimate concerns here. My colleagues and I aim to protect the interests of everyday retail investors and foster a competitive capital market system that upholds market integrity and maximizes the opportunity for all Americans, including those Iowans in my district, not just to uphold our wealth, but to make sure that we are able to be successful in their long-term retirement planning and investment decisions. Since the 1990s, the cost of entering the U.S. public market has doubled, leading to a two-thirds decrease in the number of companies that have chosen to IPO. In contrast, our foreign adversary, China, has seen a significant IPO increase, contributing to its global competitiveness. I would offer that the rogue SEC and its overregulation has as many as 52 rulemaking proposals pending, none of which deal with one of their three missions: facilitating capital formation. Instead, this SEC before us has prioritized increasingly costly regulatory and disclosure obligations, making our U.S. capital markets less attractive. So let's start from the bottom up here. In our overall perspective, the SEC rules not only are overly burdensome, particularly to small businesses and Main Streets, as I shared with Mr. Scott here, concerns about our family farms, our local ranchers, but is also allowing foreign-owned proxy companies, which make up over 97% of the market space, to overwhelmingly have a voice in America's retirement portfolios. And as we've seen, politically motivated portfolios have, in general, a 14% less return on investment than those that are market-driven. So, Mr. Girding, in your opinion, will small businesses like the ones I just highlighted that are not registered with the SEC and have never had any business dealings with the SEC be compelled to collect and submit information to the BDC as a result of the proposed Scope 3 requirements?
Congressman, the climate risk disclosure proposal, again, only requires public disclosure from publicly registered companies. That being said, we have heard companies express comments in the comment file on the scope of the Scope 3 requirement, including impacts.
And wouldn't you agree
on
that those
small
businesses would face additional costs because of this new regulation?
Congressman, the climate risk disclosure proposal includes an extensive economic analysis of all aspects of that proposal.
Would they be paying more as a result of having to meet your regulatory requirement that you're throwing out?
As I mentioned, the economic analysis, what we often call the EA.
Mr. Girding, we recognize that there will be an increased burden on small businesses, particularly the first time out there, correct?
The economic analysis solicited comments on
I understand you
on
asked
that
for their
economic
feedback,
analysis.
and they've said overwhelmingly that it will create an increased burden for them. I'm going to move to my next question since you're non-responsive on the first. In your opinion, how many of our rulemaking proposals are specifically focused on capital formation?
Congressman, all of our rule proposals focus on all aspects of our statutory
So then I want to follow up with a speech given by then SEC Commissioner Allison Lee, who argued in favor of highly malleable interpretations of the SEC's material standard. She said, "The idea that the SEC must establish the material for each specific piece of information required to be disclosed in our rules is legally incorrect, historically unsupported, and inconsistent with the needs of modern investors." Do you continue to share former Commissioner Lee's views regarding material? Yes or no?
Congressman, I don't have that speech in front of me. I would know that anytime a commissioner speaks or an acting chair speaks, she or
You have
he...
supported her in the past. Have you changed your position on this?
The view of materiality that my division follows is, as I mentioned to one of your colleagues earlier, the same definition of materiality that the Supreme Court has articulated. That's the definition that animates and guides all of our rulemaking.
Regulation SK requires that companies provide a discussion of the material factors that make an investment speculative or risky. Yes. My final moments here. Can you explain why less than 2 months on the job, Chair Gensler sought to overhaul the 2020 adopted rule, issued a redo proposal, changing from Chairman Clayton's tenure?
Congressman, as I noted to one of your colleagues earlier, there are important provisions of the 2020 rule that remain in effect. Proxy voting advisory business.
Thank you, Mr. Chair. I yield the
Gentlemen,
remainder of my time.
Gentleman's time has expired. I'd like to thank our witness for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness, the chair, which will be forwarded to the witness for his response. I ask our witness to please respond as promptly as you're able. This hearing is adjourned.